changes in group structure, step acquisition, from no control to control. So we've already discussed the scenario where a parent disposes of all or part of its shares. So we looked at when the parent sells off all of its shares, part of its shares losing control, part of its shares still maintaining control. Now, in this edition and some of the ones that will follow, we're going to look at when a parent acquires more of its shares. Okay, so in this very episode, we're going to look at when a parent who does not have control purchases an interest or an amount of shares which enables it to be a parent or have control over another. So if an entity who possesses 10% of the shares of another purchases additional 60%, control will now be established as the total now becomes 70%. So when that happens, goodwill will now have to be calculated using the fair value method at the date that control is established. Then secondly, the initial investment, that is the one that was paid out to own the 10%, will now have to be remeasured to fair value and treated as if it was disposed of. Then gain on loss on the remeasurement in step 2 has to be recorded in the profit or loss account. Okay. Then the initial investment, that is the one on the 10% holding that was remeasured to fair value, and the actual amount paid, that is the one that was paid to own the 60%, will now be the total cost of the new investment. That is the 70% that the parent now holds. The cost of investment will now be the addition of the two. Okay. Let's now move on to look at how goodwill will now be calculated as seen in the step 1. So for the workings, we'll start with the cost of the additional investment, that is for the 60%. We add the fair value of the existing investment, that is the 10%. Then we add the non-controlling interest at the date of acquisition. Okay, the date that control was established, their value will have to be brought here and added. Then we less the net asset of the subsidiary at the date that control was established. Okay, the sum of it will give us the goodwill at acquisition. Okay, so we quickly test our understanding. Jerry acquired 20% of the equity shares of Donald for $60 million some years ago. Now, on the 1st of January 2021, Jerry acquired an extra 35% for $90 million when the fair value of the net assets of Donald were $120 million. The investment was classified as fair value through profit or loss. The fair value of the non-controlling interest on 1st January 2021 was $25 million. The fair value of the original 20% holding was $20 million. Now we have to calculate the goodwill and new cost of investment to be recorded in the Jerry's Group Statement of Financial Position as at 31st December 2021. So for solution, we start by bringing the cost of the additional investment, that is the 35%, which was stated in the question as $90 million. We add the fair value of the existing 20%, which was $20 million in the question. We add the non-controlling interest at the date that the 35% was acquired, $25 million. Then we less the net asset of the subsidiary, which is Donald, at acquisition, $120 million, which will provide goodwill at acquisition of $15 million. For the new cost of investment, it's going to be $110 million, which is the sum of the $90 million extra investment made plus the fair value of the existing investment, which was $20 million in the question. We test our understanding again. Cyril bought 40% of the equity interest of Zara for $30 million 5 years ago. Cyril purchased additional 50% interest on 1st June 2020 for $50 million. The fair value of the net assets on 1st June 2020 of Zara were $100 million. The investment was classified as fair value through profit or loss. The fair value of the non-controlling interest on 1st June 2020 was $30 million, and that of the original 40% interest was $40 million. We have to calculate the new cost of investment and goodwill to be recorded in Cyril's Group Statement of Financial Position as at 31st December 2020. So for solution, we start by bringing in the cost of additional investment for the 50%, $50 million. We add the fair value of the existing 40%, $40 million. We add the non-controlling interest value of $30 million. We less the net asset of the subsidiary at acquisition, which was captured in the question as $100 million. Then the sum or the net will give us goodwill at acquisition of $20 million. We have the new cost of investment to be $90 million, which is the sum of $50 million, the cost of additional investment, plus the $40 million, which is the cost or the fair value of the existing investment of the 40%.